On the same week that Ray Dalio, the billionaire who built Bridgewater Associates into the largest hedge fund on the entire planet, went on a widely followed podcast and compared today's artificial intelligence frenzy to the exact conditions that preceded both the 1929 crash and the 2000 dot-com collapse. A quiet, unglamorous government agency, thousands of miles removed from Wall Street's trading floors, was doing something almost nobody in finance was paying any real attention to: the defense. Advanced Research Projects Agency, DARPA, the same organization that helped birth the internet decades before anyone called it that, was expanding a program specifically designed to do the one thing Wall Street's AI boom has conspicuously avoided doing for the past 3 years: rigorously, skeptically, mathematically verify whether a wildly hyped technology actually delivers value that exceeds its cost before anyone gets to declare victory. That program is called the Quantum Benchmarking Initiative, and while it has almost nothing to do with artificial intelligence on the surface, the discipline behind it stands as a quiet, almost accidental rebuke to exactly the kind of unchecked, momentum-driven enthusiasm currently propping up trillions of dollars in AI valuations. This is the story of what DARPA is actually doing, why its approach to a different frontier technology exposes something uncomfortable about how the AI boom got priced, and why Wall Street, so focused on NVIDIA's next earnings call, never saw this particular warning coming from an entirely different direction. To understand why DARPA's quantum program matters here, you first need to understand what it actually is, because it is not, despite how the headline framing might suggest, some kind of secret weapon being deployed against artificial intelligence stocks. The Quantum Benchmarking Initiative, known within the agency as QBI, is a deliberately narrow, deliberately rigorous effort launched by DARPA's Microsystems Technology Office to answer one specific, brutally honest question: can any current approach to quantum computing actually achieve what the industry calls utility scale operation, meaning a machine whose computational value genuinely exceeds what it costs to build and run by the year 2033? That's it. That's the entire mission. Not whether quantum computing sounds exciting, not whether venture capital wants to keep funding it, not whether a press release from a quantum startup generates a stock pop, whether the actual measurable economics work out, verified independently by an agency with no financial stake in seeing any particular company succeed. The program's structure alone tells you everything about how differently DARPA approaches emerging technology compared to how Wall Street has approached artificial intelligence over the past 3 years. QBI unfolds across 3 deliberately sequential stages, and the bar to advance through each one is genuinely difficult to clear. In Stage A, companies get 6 months to characterize their specific technical concept for building a useful, fault-tolerant quantum computer, laying out exactly how their particular hardware approach would theoretically work. Only the strongest, most technically credible proposals move forward. As of November 2025, DARPA had selected 11 companies to advance into the far more demanding Stage B, a full, year-long phase where those companies must develop detailed research and development plans, explicitly identify the technical risks standing between their current hardware and genuine utility-scale operation, and specify concrete risk reduction prototypes that would need to work before anyone could credibly claim the underlying approach is viable. Beyond that sits Stage C, where DARPA actually attempts to verify and validate whether the proposed system can be built and operated as intended, the final, hardest test separating genuine technical breakthroughs from expensive, well-marketed disappointments. Quantinuum, one of the most prominent names in the industry, publicly confirmed its own selection into Stage B in July 2026, a milestone the company treated as a genuinely significant validation, precisely because DARPA's evaluation process is understood across the industry as one of the hardest, most skeptical gauntlets any quantum computing company can currently be put through. What makes this approach so quietly damning when held up against the AI investment boom is not any single technical detail about qubits or fault tolerance. It's the underlying philosophy driving the entire program, a philosophy DARPA has been remarkably explicit about in its own public communications. The agency has repeatedly framed QBI's entire purpose around a specific, uncomfortable goal to separate genuine technological hype from underlying economic reality, armed in the agency's own words with a healthy dose of skepticism, scientific rigor, and both industry and academic expertise. DARPA isn't asking whether quantum computing is exciting. Exciting is cheap, and every emerging technology gets that adjective attached to it eventually. DARPA is asking whether the actual computational value quantum hardware produces will exceed what it costs to build, operate, and maintain, a question phrased in the blunt, unforgiving language of cost-benefit accounting rather than the breathless language of technological inevitability that has dominated so much of the public conversation around artificial intelligence. If you're finding this contrast as striking as I do, a defense research agency demanding proof before hype, while an entire stock market races ahead on the opposite assumption, go ahead and hit like and subscribe now, because the specific numbers behind exactly how far AI valuations have run ahead of that same kind of rigorous economic verification are genuinely staggering, and we're about to walk through them directly. Now turn to the other side of this story, because to appreciate what DARPA's approach actually highlights, by contrast, you need to sit with just how differently Wall Street has behaved around artificial intelligence over roughly the same period QBI has been quietly running its verification gauntlet. By the summer of 2026, global AI investment was on pace to exceed $2.5 trillion for the year alone, an almost incomprehensible sum flowing into data centers, chips, cloud infrastructure, and enterprise software, all built around the assumption that artificial intelligence's transformative economic potential justifies valuations that, by several traditional measures, now sit in territory previously associated with history's most infamous speculative bubbles. NVIDIA, the chipmaker whose graphics processors sit at the center of nearly every major AI build-out, had surged more than 880% over roughly 3 years leading into 2026, and the broader concentration of the stock market around a handful of dominant technology names had reached a level genuinely unprecedented even compared to the dot-com era. By mid-2026, the top 10 stocks in the S&P 500 represented roughly 35% of the entire index's total value, compared to only 25% at the actual peak of the dot-com bubble in 2000, meaning a shockingly narrow slice of companies, most of them tied directly to the AI build-out, now determines the fate of the broader retirement accounts and index funds that ordinary investors around the world depend on. The valuation metrics underlying this concentration have started triggering exactly the kind of historical alarm bells serious market historians take seriously. The Shiller cyclically adjusted price-to-earnings ratio, a long-running valuation measure that smooths out short-term earnings noise to compare current stock prices against a decade of historical profitability, exceeded 40 during 2025, a level that had only been reached once before in the entire history of that particular metric, and that one previous instance came immediately before the dot-com crash wiped out trillions of dollars in market value across 2000 and 2001. That specific historical echo is precisely why Ray Dalio's August 2026 warning landed with the weight it did. Speaking on a widely followed podcast, Dalio, whose own hedge fund has navigated multiple genuine market cycles across 4 decades, explicitly warned that the runaway enthusiasm currently surrounding artificial intelligence mirrors the exact conditions that preceded both the 1929 crash and the 2000 dot-com collapse, pointing specifically to excessive leverage building up across market participants and a broader tendency to simply ignore underlying asset valuations in favor of chasing momentum. He wasn't alone. Around the same period, JP Morgan's own chief executive, Jamie Dimon, had separately been sounding similar notes of caution, and economists at the European Central Bank published their own formal analysis, warning that a meaningful market correction should be expected, explicitly noting that this holds true even in the more charitable scenario where today's AI valuations turn out to be an entirely accurate reflection of the technology's genuine capacity to reshape the global economy, because history consistently shows that investors eventually demand higher risk premiums once the fate of the broader economy becomes tightly bound to whether a small handful of companies succeed. It's worth sitting for a moment with exactly why this specific warning matters more than the countless other bubble warnings that circulate constantly across financial media, most of which prove wrong or premature. What separates the current moment from ordinary market chatter is the specific and structural nature of the concern being raised. Not merely that AI stocks are expensive, but that the entire architecture of how those valuations are being justified relies on a chain of assumptions that have never been independently, rigorously verified, the way DARPA's own quantum program insists on verifying its own comparably ambitious technological bets. Peter Oppenheimer, Goldman Sachs' chief global equity strategist, offered a particularly precise version of this concern in mid-2026, arguing that there does not necessarily appear to be a straightforward valuation bubble in the traditional sense, meaning stock prices relative to current earnings, but that there may instead be what he specifically termed an earnings bubble, a subtler, arguably more dangerous problem where the underlying corporate profits themselves, the very foundation everyone assumes current valuations are built upon, may not hold up under closer scrutiny once the enormous capital expenditure currently pouring into AI infrastructure needs to actually start generating a durable, sustainable financial return. This distinction between a valuation bubble and an earnings bubble is worth explaining in plain terms, because it captures precisely the kind of scrutiny DARPA applies routinely to quantum computing, but that Wall Street has, by comparison, applied only unevenly to artificial intelligence. A valuation bubble happens when investors pay too much for a company relative to its current real profits. An earnings bubble happens when the profits themselves are being artificially inflated or sustained in ways that won't hold up once the underlying economic conditions shift, meaning the company looks financially healthy today for reasons that may not persist. Torsten Slok, a prominent Wall Street economist who has been warning about interest rate dynamics since at least 2023, sharpened this exact concern into a specific mechanical worry by mid-2026, pointing out that a meaningful portion of current bond market pressure was being driven specifically by what he called hyperscaler issuance. The enormous volume of corporate debt major technology companies have been taking on specifically to fund their AI data center buildouts. Slok's own explicit warning, delivered in early August 2026, stated plainly that the real risk to the broader market emerges specifically if the AI trade itself reverses, or if markets simply become more anxious about the mounting scale of government and corporate deficits financing this entire build-out, a structural vulnerability sitting quietly underneath the market's record highs that has nothing to do with whether artificial intelligence itself is a genuinely valuable technology, and everything to do with whether the specific financial architecture currently funding its expansion can withstand any meaningful shock. This is exactly the kind of structural cost versus value question DARPA's Quantum Benchmarking Initiative was specifically designed to interrogate before allowing any quantum computing company to claim victory. And the contrast between the two approaches becomes genuinely striking once you place them side by side. DARPA does not simply ask whether a quantum computing company has built an impressive-looking demonstration or generated exciting headlines. It asks, specifically and mathematically, whether the computational value that system produces will actually exceed what it costs to build and operate, verified through an independent multi-stage evaluation process spanning years rather than a single earnings call or product launch event. Applied to artificial intelligence, that same discipline would require asking a genuinely uncomfortable question that surprisingly few voices on Wall Street have pushed hard enough on throughout the current boom, whether the enormous, escalating capital expenditure currently pouring into AI data centers, chips, and infrastructure will actually generate revenue and profit that exceeds those costs on a timeline investors can realistically tolerate, rather than simply assuming, as momentum-driven markets tend to, that the technology's broader transformative potential automatically justifies whatever price tag gets attached to it today. It's genuinely worth being fair to the other side of this argument here, because dismissing the entire AI investment boom as pure, ungrounded speculation would itself be an oversimplification of a genuinely complicated, evolving picture. And serious, credible voices continue to argue the current valuations reflect something real rather than pure mania. Evercore ISI, one of the more influential research shops on Wall Street, has projected the S&P 500 could climb as high as 9,000 over the following 12 months, a genuinely bullish call built on the argument that AI's productivity gains and revenue potential remain considerably underappreciated by markets still anchored to skepticism left over from previous technology cycles that failed to deliver. Deutsche Bank's global economics team, in its own mid-2026 outlook, explicitly reaffirmed a bullish year-end target for the S&P 500 around 8,000, forecasting continued double-digit earnings growth driven by strength across both the technology and financial sectors, framing 2026 not as a repeat of the dot-com collapse, but as something closer to a more complicated blend of genuine technological transformation colliding with separate, unrelated macroeconomic pressures like elevated interest rates and geopolitical energy shocks. And unlike the speculative dot-com companies of 2000, many of which had no meaningful revenue at all, today's dominant AI companies, NVIDIA chief among them, are generating enormous, genuinely real profits right now, not merely promising them somewhere in a distant hypothetical future, a meaningful structural difference that gives the current boom's defenders real ammunition against a simple, direct comparison to previous historical bubbles. But even accounting for that legitimate, defensible counter-argument, the core discomfort DARPA's approach quietly exposes doesn't fully go away, because the specific test QBI applies to quantum computing isn't simply whether a technology generates real revenue today. It's whether the full, independently verified economics work out relative to the total cost of building and sustaining the system at scale over the entire timeline required to reach genuine utility, applied with that same rigor to artificial intelligence. The question stops being simply whether NVIDIA's quarterly earnings look impressive right now and becomes instead whether the trillions of dollars in cumulative capital expenditure currently being poured into AI infrastructure, much of it financed through exactly the kind of hyperscaler corporate debt issuance Slok flagged as a specific systemic risk, will ultimately generate a return that justifies that entire cumulative investment, verified independently rather than simply assumed because current quarterly numbers happen to look strong. That is a considerably harder, considerably more uncomfortable question than the one Wall Street's headline coverage tends to actually ask. And it is precisely the kind of question an agency like DARPA has built an entire multi-year, multi-stage institutional process, specifically to force quantum computing companies to answer honestly, whether the answer turns out to be flattering or not. There's also a deeper, more philosophical layer to this contrast worth sitting with directly, because it reveals something genuinely important about how differently government-funded frontier research and momentum-driven public markets tend to handle uncertainty around genuinely transformative technology. DARPA has no shareholders demanding quarterly growth, no stock price reacting in real time to every press release, no fear of missing out driving its evaluation timeline forward faster than the underlying science actually supports. That institutional insulation from short-term market pressure is precisely what allows the agency to insist on a 6-year runway toward 2033 before declaring victory or failure on quantum computing's genuine commercial viability, patience that Wall Street's quarterly earnings cycle structurally cannot afford to extend toward artificial intelligence, regardless of how much genuine technical merit the underlying technology might ultimately turn out to have. Public markets are, by their very nature, forced to price uncertain, still unfolding technological transformations in real time, continuously, based on incomplete information, sentiment, and competitive positioning, rather than waiting patiently for a rigorous, multi-year, independently verified answer the way DARPA's own institutional structure permits. That structural mismatch, patient, skeptical multi-year verification on one side and impatient, sentiment-driven, real-time pricing on the other, is arguably the single most important, least discussed force, separating how a defense research agency approaches quantum computing from how Wall Street has approached artificial intelligence, and it helps explain why so few people initially connected these two seemingly unrelated stories in the first place. None of this means artificial intelligence itself is destined to collapse the way speculative .com companies did in 2000, and it would be a genuine overreach to draw that direct a conclusion simply from the existence of a government quantum research program, operating with more institutional patience than the public stock market currently allows itself. What DARPA's approach to quantum computing genuinely offers, though, is a useful, concrete template for exactly the kind of rigorous, skeptical cost versus value scrutiny that a healthy, sustainable AI investment boom would eventually need to survive its own version of. Whether that scrutiny comes from Wall Street analysts finally applying considerably more discipline to their own earnings forecasts, from regulators taking a harder look at the debt financing structures underpinning the current data center build-out, or simply from the passage of enough time to reveal whether today's enormous capital expenditure genuinely translates into revenue that justifies it. The same fundamental test DARPA has spent years building an entire institutional apparatus, specifically to apply to a different, equally hyped frontier technology. Perhaps the most striking part of this entire comparison is how quietly it has unfolded, almost entirely outside the notice of the financial media currently consumed with tracking NVIDIA's stock price minute by minute. DARPA's Quantum Benchmarking Initiative doesn't generate viral headlines or move markets the way a single confident tweet from a tech executive can. It operates through unglamorous program announcements, technical solicitations, and multi-stage evaluation timelines stretched across years, the kind of institutional machinery that rarely earns coverage outside specialized industry publications like the Quantum Insider or HPC Wire. Yet buried inside that quiet, methodical bureaucratic process sits a genuinely pointed implicit challenge to the entire framework currently justifying trillions of dollars in AI-related market capitalization. A challenge phrased not as a dramatic prediction of collapse, but as a simple, stubborn institutional insistence that computational value must actually verifiably exceed cost before anyone gets to declare victory. A standard artificial intelligence as an industry has not yet been forced to meet with anywhere near the same rigor, and one that Wall Street, caught up in record highs and eye-popping price targets, never saw coming from the direction of a defense research agency working on an entirely different, seemingly unrelated technology altogether. It's also worth pulling apart, in a bit more technical depth, exactly what makes quantum computing such an unusually apt candidate for this kind of skeptical patient government verification process in the first place. Because the comparison to artificial intelligence isn't purely a matter of institutional style. Quantum computers, unlike the classical machine learning systems currently powering the AI, exploit genuinely strange physical phenomena, superposition, entanglement, quantum interference, to perform certain categories of calculation in ways no classical computer, no matter how powerful, can efficiently replicate. That theoretical promise has generated its own decades-long wave of enthusiasm and investment, with companies across the industry, IBM, Google, IonQ, Rigetti, and Quantinuum among them, racing to demonstrate increasingly impressive technical milestones. But quantum hardware remains notoriously fragile, prone to accumulated errors that compound as calculations grow longer and more complex, a problem researchers call decoherence, and building a genuinely fault-tolerant, error-corrected quantum computer capable of outperforming classical machines on real, economically valuable problems remains one of the hardest unsolved engineering challenges in modern physics. That combination, genuine, verified theoretical promise, sitting alongside genuinely unresolved, extraordinarily difficult engineering hurdles, is exactly the kind of situation where independent, rigorous, cost versus value verification matters most, precisely because the gap between an impressive laboratory demonstration and a genuinely useful, cost-justified commercial machine has proven, across quantum computing's entire history, to be considerably wider and considerably harder to close than early enthusiasm consistently suggested it would be. That same gap between an impressive demonstration and genuine cost-justified commercial value sits at the center of the AI bubble debate too, even if the underlying technology looks completely different on the surface. Artificial intelligence models have become remarkably capable at an astonishing range of tasks: writing code, generating images, holding conversations, analyzing enormous data sets, capabilities that were genuinely difficult to imagine as recently as 5 or 6 years ago. Nobody serious disputes that the underlying technology represents a genuine, significant advance. The uncertainty Wall Street's more cautious voices keep raising isn't about whether AI works. It's about whether the specific pace and scale of capital expenditure currently being poured into building it out, the hundreds of billions of dollars in data centers, specialized chips, and power infrastructure, will generate a return that justifies that spending within a time frame investors can realistically tolerate, rather than requiring a much longer, much more patient horizon closer to the kind DARPA has explicitly built into its own quantum computing verification timeline. That is precisely the structural mismatch worth returning to, a 6-year institutionally patient verification runway on one side of this comparison, and a market structurally built around quarterly earnings calls and real-time stock price reactions on the other, both of them staring down comparably uncertain, comparably transformative frontier technologies, but doing so through fundamentally incompatible timelines for demanding actual proof. There's a further wrinkle worth examining here, too, because DARPA's own history with exactly this kind of skeptical, patient verification process offers a genuinely useful precedent for thinking about how the current AI boom might eventually resolve itself, one way or the other. The agency has, across its entire history, funded a long list of genuinely transformative technologies, the earliest foundations of the internet itself among the most famous examples, precisely by applying the same disciplined, multi-stage approach, funding ambitious research, rigorously testing whether it actually works as promised, and only declaring success once independent verification actually confirms it. That track record cuts in an interesting double-edged direction here. On one hand, it suggests DARPA's current skepticism toward quantum computing shouldn't be read as pessimism about frontier technology broadly, since the same agency has repeatedly funded and validated genuinely transformative breakthroughs throughout its history using exactly this kind of rigorous process. On the other hand, it also means DARPA's institutional standard for what counts as genuine, verified success is deliberately, consistently higher than the bar public markets have applied to artificial intelligence throughout the current boom, which is precisely the uncomfortable comparison this entire story keeps circling back around to. It's also worth considering how ordinary investors, people with retirement accounts and index funds rather than institutional, trading desks should actually think about processing this comparison, because the honest answer avoids both extremes, neither panicking and abandoning AI exposure entirely, nor dismissing the mounting chorus of serious warnings as simple, reflexive pessimism from people who have been predicting a crash for years without it materializing. Several of the specific structural concerns raised throughout 2026, the unprecedented concentration of index funds around a handful of dominant AI-linked companies, the growing reliance on corporate debt issuance to finance data center buildouts, and the widening gap between current earnings and the multi-year capital expenditure required to sustain the current pace of AI infrastructure growth are concrete, trackable indicators rather than vague, unfalsifiable predictions. An investor genuinely interested in applying something like DARPA's own disciplined skepticism to their own portfolio decisions might reasonably focus less on trying to precisely time whether or when any eventual correction arrives, an exercise that has humbled even the most sophisticated professional forecasters throughout market history, and focus instead on whether their own personal exposure to this concentrated risk, through index funds, retirement accounts, or direct stock holdings, matches their own actual tolerance for the kind of sharp, sudden correction that history suggests tends to eventually follow exactly this combination of extreme valuation, concentration, and unresolved questions about underlying earnings sustainability. Stepping back from the specific mechanics of either quantum computing or artificial intelligence, what this entire comparison ultimately illustrates is something considerably broader about how societies handle genuinely transformative, genuinely uncertain new technology, a pattern that has repeated across nearly every major technological shift in modern economic history. Enthusiasm nearly always runs ahead of verified proof because markets are fundamentally built to price the future, not simply the present. And pricing an uncertain future inevitably involves betting on possibilities that haven't yet been rigorously confirmed one way or the other. The railroads of the 19th century, the radio boom of the 1920s, the dot-com bubble of the late 1990s, and now the AI investment boom of the mid-2020s all share this same underlying pattern. Genuine, transformative technology arriving alongside a wave of investment that initially outruns the pace at which that technology's actual economic value can be independently verified. What makes DARPA's quiet, parallel approach to quantum computing genuinely instructive here isn't that it predicts artificial intelligence will necessarily follow the same painful correction those earlier bubbles eventually experienced. It's that the agency's entire institutional structure demonstrates, in real time, exactly what a more patient, more rigorous, more genuinely skeptical alternative to momentum-driven market enthusiasm actually looks like in practice. A standard artificial intelligence as an industry has, at least so far, been allowed to largely bypass, resting instead on the assumption that today's extraordinary momentum will simply continue, an assumption every previous technological boom in history has eventually tested, and more than a few of them have ultimately failed. Stepping back even further, there's a genuinely important distinction worth naming plainly before closing this out, because framing the story as DARPA versus artificial intelligence risks flattening something considerably more nuanced into an overly simple headline. DARPA isn't opposed to artificial intelligence, and the agency itself has separately funded and pursued numerous AI-related research initiatives throughout the very same period it has been running QBI, including recent collaborative work applying AI systems to genuinely practical government tasks like environmental review documentation. The point of this comparison was never that DARPA is somehow taking a side against Wall Street's AI enthusiasm. It's that the specific discipline DARPA applies to one ambitious, uncertain frontier technology happens to expose, entirely by coincidence rather than design, exactly the kind of rigorous scrutiny that critics of the AI investment boom keep on arguing has been conspicuously, uncomfortably absent from how public markets have priced an equally uncertain, equally ambitious technological transformation. A coincidence worth sitting with, regardless of which side of the AI bubble debate you personally find more persuasive. Whether the AI boom ultimately proves to be the genuine, durable economic transformation its most bullish defenders continue to argue it represents, or whether it eventually reveals itself to be an earnings bubble built on capital expenditure that outran its own eventual return. Exactly the kind of uncomfortable possibility Goldman's Peter Oppenheimer and economists at the European Central Bank have both begun quietly flagging. Throughout 2026, DARPA's own separate, methodical approach to a comparably ambitious and comparably uncertain frontier. Technology offers a useful, sobering mirror for anyone willing to actually look into it. Quantum computing companies currently working through QBI's grueling multi-year verification gauntlet don't get to simply declare success because investors are excited or because a demonstration generated a headline. They have to prove it rigorously, independently, against a hard 2033 deadline before anyone gets to call it real. Artificial intelligence, propped up by record-breaking market capitalization and trillions of dollars in ongoing infrastructure spending, has largely been allowed to skip that same kind of independent, skeptical verification process entirely, at least so far, resting instead on the assumption that current momentum and genuinely impressive quarterly earnings will simply continue indefinitely, an assumption history has, more than once before, eventually proven considerably more fragile than it looked at the time. There's also a final, quietly ironic dimension to this entire comparison worth naming before wrapping up. Because quantum computing itself has, at various points across its own history, generated exactly the kind of premature hype cycles now under scrutiny in the AI space. And DARPA's own current skepticism partly exists as a direct, hard-won response to those earlier disappointments. Various quantum computing announcements over the preceding decade generated genuine excitement, and in more than one instance, subsequent independent scrutiny revealed that the underlying claims had outrun what the actual hardware could reliably demonstrate at the time. That history is precisely why an agency like DARPA now insists on a rigorous, multi-year, independently verified process before crediting any company's claims about utility-scale quantum computing, rather than accepting confident announcements at face value the way markets so often do. The lesson embedded in that history applies with equal force to artificial intelligence, a technology whose own genuine capabilities are considerable, but whose surrounding investment narrative has, according to a growing chorus of serious voices across finance in 2026, been allowed to run meaningfully ahead of the same kind of rigorous, independent verification. Quantum computing has already been forced to undergo a gap that history suggests rarely closes painlessly on its own. If you want to keep following exactly how this quiet standoff between rigorous, patient government verification and momentum-driven public market enthusiasm continues to unfold, whether DARPA's quantum program actually produces a genuinely validated utility-scale computer by 2033, and whether the AI investment boom eventually proves its own economics hold up under the same kind of scrutiny, make sure you're subscribed because both of these stories are still very much being written, and the connection between them is only going to become more relevant as both timelines continue to play out. Thanks for watching all the way through, and don't forget to like and subscribe so you catch the next update in this story the moment it happens.